So I'm sure we are all familiar with a term called institutional ownership, which shows us how many investment firms and hedge funds own a particular stock. And I'm sure y'all are also familiar with the fact that analysts on Plug Power have an average price target of almost $38, which implies a supremely impressive upside of over 100%. But the question that many investors don't ask is that could these two bullish metrics actually be a detriment to the stock in the long term? And can Plug stock realistically double in 12 months as most analysts expect? These questions are exactly what we're going to cover in this video. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's actually look at the institutional ownership percentage of Plug Power stock, which has gone up significantly since 2020, because obviously the stock has gone up a lot as well. And since funds typically like to follow where most of the momentum and volume is, we have seen a lot of analyst coverage already start coming onto Plug Power. And that's a big reason why their consensus price target is so high. As you can see, 54% of the entire outstanding share count of Plug is owned by institutions, and those are primarily driven by massive funds and ETFs that want exposure to the clean energy industry. And as public stockholders, we only own around 35% of the overall company, which is definitely not a bad thing, but the institutional number can be a slight concern in the long term because it shows us that potentially a lot of the pricing of growth could already be priced into the valuation. Now, why could that be the case? Well, as you can see, Plug is trading at a price of sales of 19, which is generally considered to be very expensive. But as I've justified over the past couple of months, this valuation is okay because this company is growing at 90% plus year over year. But the idea here is that in the long term, as they gain more market share, their growth is obviously going to slow down, and analysts already expect them to grow by around 40% in 2023 with 80% growth in 2022. And a big reason why these valuations, even on stocks like HYLN and Ballard Power, are so high is because institutions are still very big fans of these companies today. And as we've already seen over the past 6 months in this bear market, high valuations don't really last that long when investors are fearful about inflation. And so it's actually very impressive that these stocks have held up so well. But it does also add a certain degree of risk because it means that there is a lot of pressure on the sell side if institutions suddenly see that their investment thesis is no longer valid. And although the analyst price targets are always nice to have, they can be a little bit of a hindrance because it shows us that institutions can actually decide where the stock goes in the short term. And during times of economic uncertainty, it's going to be the institutional investors that are going to be the first to sell their stocks if their thesis change, because they have a lot of clients that they need to impress. And if these clients see that these investors are not doing a good job with their money and buying risky assets with poor fundamentals, then they're going to be very fast to pull out their money. And since most portfolio managers only make a commission based on the amount of money that's in their portfolio, this is certainly a little bit of a headwind if you're considering about the institutional effect on Plug stock. And at least for me, one of the biggest reasons institutional investments can be a little bit bad is because by the time everybody has piled into the stock, it could mean that the company has already peaked in terms of its business fundamentals. Because most institutions don't like to buy stocks when they're in the penny stock phase, which is what Plug stock was back in 2019. Instead, they now pile into the stock when all of a sudden it has skyrocketed and gotten about $5, $7, and then $10. And so often it can remove some of the edge that you have as a retail investor, because obviously a lot of big money is already supporting the company. But this is not all bad news. There is light at the end of the tunnel because institutional ownership for Plug is actually only at 54%. And although that is very high compared to other penny stocks and high-risk tech stocks, it is not that high compared to other companies in the very high growth space like Etsy and even CrowdStrike. Etsy and CrowdStrike are stocks that are great examples of very high growth businesses that have moved into profitability. And although the stock has underperformed since the past 6 months due to this bear market, as you can see at the very peak, institutional ownership was around 98%, which means that on a paper basis, Plug Power has still a lot of upside even from other fund managers. And as the current administration starts pushing more emphasis on clean energy and hydrogen investments, we should start seeing a lot of inflows into one of these specific clean energy ETFs, ticker symbol ICLN. And the reason why that is going to be good for Plug Power is because, as you can see, it is around a 4% weight in this entire ETF right now, only lagging behind stocks like Enphase, SolarEdge, and Vestas. This is a pretty big acknowledgement of Plug Power's leadership in the hydrogen industry, because right now it is one of the only unprofitable companies on this top 10 list. And so how exactly could Plug's institutional ownership still go higher from here? Let's listen into TD Ameritrade's recent show where TipRanks announced their Plug Power stock ratings and how they have improved over the past 6 months.
Plug Power is an interesting example because of the three here really beat up over the last 6 months, down 37% on the year. But it was down a lot more before its last earnings, which kind of coincided with the bottom. Is that a coincidence? Did analysts like what they saw in the report?
Yeah, I think Plug Power is an interesting one. We are down about 70% from highs back in 2020, 2021. And they did take a big dip when they reported those wider than expected loss in the last earnings. But I think we are finding a bottom here. I think what analysts got really excited about in recent weeks was their big order for that 1 gigawatt hydrogen electrolyzer. So they're starting to see more growth momentum for the company moving forward. And I think we're nearing that bottom where we might start to see this turnaround.
Morgan Stanley thinks that this estimate, this order that you're talking about here is going to be pretty revenue positive for these companies. They've still got a pretty long path to earnings positivity, though, right? I mean, still losing money every quarter.
Yes, so they still are losing money. This is a relatively new growth company, so not a big surprise there. But they have big goals. Like you said, this project, they're expecting it to bring $500 million in revenue by the time it's delivered in 2024. And outside of that, the company's planning on doubling their revenue every year now for the foreseeable future. So they have some big goals here as far as reducing costs, increasing that operating margin. And I think we'll see them turn to profitability here within the next couple of years.
Okay. So the analyst price target's 95%. I guess that's why Andy Marsh, the CEO, was so sanguine last time he was on our show. He was all smiles and good spirits despite the stock getting killed. So, wow, that's a pretty big expectation from analysts that they're looking for this thing to double.
Well, it's no surprise that the argument of lack of profitability came up in this specific interview, because at the end of the day, that's what Wall Street mostly cares about. But the good thing is that Plug Power is at an inflection point within the next 24 months. And as we all know, inflection points are typically the points at which institutions like to build their positions, because some funds will not touch a stock even if it is extremely high growth with a very good leadership position with a lot of cash on the balance sheet like Plug, unless it's cash flow positive. And the good thing is that for Plug, that is going to occur within the next 24 months, as mentioned by the CEO. And that could certainly be an inflection point in the stock, even though it has been destroyed over the past 12 months, which I think is primarily attributed to this NASDAQ bear market. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below how many shares of Plug do you guys own and whether or not you're buying the dip right now. But anyways, guys, hope you enjoyed this video, and I'll catch you guys in the next one. Take care.